Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the fifth and final video in our 5-part video series called Where to Buy Investment Property. In the first 4 videos, we looked at demand factors such as infrastructure spending, population growth, and job creation, as well as the supply factors. In this video, we're going to be looking at amenity. Amenity is probably the most obvious factor regarding property price growth, but it's on a different scale to the other factors we've talked about. We've already ascertained that by this stage what city, region or town we're going to invest in. So now we're looking at the factors that will determine the best capital growth within that region. Amenity makes it easier to live in a location. Nearby schools, shops, transport and recreation facilities are the most important. Of course, there are plenty of other examples. Private schools, universities, medical facilities, beaches and so on. The closer your investment property is to these things, the better, since people will pay a premium rent and a premium price to live near these modern conveniences. The amenity factor, however, does need to be kept in perspective. Most investors and almost all real estate agents and property industry people overstate the importance of this factor at the expense of the factors we've covered in the first 4 videos: infrastructure spending, population growth, job creation, and limited supply. To illustrate this point, consider what property would grow more in value and get a higher rent. A property well located for amenity where there's no infrastructure spending, no population growth, and no job creation? Or a property in a region that has all these factors, but it's a bit further away from the shops, the schools, and the train station? The latter will obviously have the better growth, but 99% of investors miss this point. If you want to find out more about the subjects covered in this 5-part video series, then download our free ebook called How to Invest in Property and Achieve Capital Growth Safely for less than $100 a week. It's yours free. Just visit propertyinvestmentprofessionals.com.au. Thanks for watching. Bye for now. Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the 4th video in our 5-part video series called Where to Buy Investment Property. In videos 1 to 3, we looked at infrastructure spending, population growth, job creation, and the safety that's created by diversity. These are all factors on the demand side of the equation, but of course there's the other side to look at, the supply side. So we need to ensure that where we're buying, where we've found all these demand factors, there's also not too much supply. Generally speaking, this doesn't come up as a problem in too many areas where the other demand factors are present, because generally speaking across Australia, there's plenty of red tape that tends to keep the rate of supply limited. Often councils are slow in zoning land for higher density development and in approving new developments. So when the demand factors that we talked about in videos 1, 2 and 3 in this series are present, the supply usually isn't. By the time the developers get around to buying the land, getting it rezoned, getting their developments approved, getting them funded, which usually involves selling them off the plan, at least 3 or 4 years has usually gone by, in which time shrewd investors have already had a good chance to achieve some good strong rental growth and price growth. By the time supply starts coming on board, it often doesn't overtake demand, or if it does, it doesn't tend to do so for long periods of time. However, there is something to be very careful of. If there are signs of an oversupply in the market, then it probably also means that the demand factors are not present in sufficient quantities to warrant investing there anyway. Oversupply problems usually come about in the form of high-rise buildings or broadacre developments in the outer suburbs. And usually what causes this is a runaway property boom. This happens in places like the high-rise areas of the Gold Coast and the outer suburbs of Melbourne every 10 years or so. A boom that probably shouldn't have taken place, meaning that there was a lack of the demand factors that we talked about in the first 2 videos in this series. But there was a buying frenzy all the same. Too many properties created for the market, and then a slump, driven mainly by oversupply. So it's important to look at the supply factors as well as the demand factors to ensure your investment property is not going to be in an area that's oversupplied. And one important thing that will help determine this on a more local level is amenity. And we'll look at amenity in the 5th part in this video series. And you can find that at propertyinvestmentprofessionals.com.au or by clicking on the link on this page. Hi, It's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the third video in our 5-part video series called Where to Buy Investment Property. In the first two videos, we looked at the importance of infrastructure spending, job creation, and population growth on achieving our objectives of high capital growth for $100 a week or less and doing so safely with minimal risk. And it's this safety that brings us to the subject of this video. Safety is achieved through diversity. It's critically important as a property investor that we don't take on unnecessary risk. You could find a property investment with all the factors that we've looked into in the first two videos in this series, plenty of infrastructure spending, rising population and jobs being created. But if all this spending, all these jobs, and all this rising population is all in one industry, then naturally your risk levels are increasing. Sometimes you can get all these factors present, and it's not just siloed in one industry, it's even higher risk if the developments are related to just one company. So in the same way that your stockbroker may advise you to diversify risks by buying shares across a number of companies in a number of industries, you should keep the same principles in mind when investing in property. The more companies and the more industries, the better. Large capital cities tend to be the safest because places like Sydney, Melbourne, Brisbane, and some of our other capital cities all have dozens of industries and hundreds of companies to make them diverse. At the other end of the scale, some smaller towns are reliant on just one industry. For instance, some coastal towns are over-reliant on tourism, and some small inland towns are over-reliant on just agriculture, even one crop in some cases. In between, we have the large regional centres, and some of these are more diverse than others. So the best thing you can do is to keep your risk to a minimum by investing in areas where there's a number of industries. The more the better, and even better if these industries are investing in infrastructure, creating jobs, and causing the local population to grow, attracted by the jobs. These factors create demand, and in the next video we'll be looking at the supply factors, and you can watch that video at propertyinvestmentprofessionals.com.au or by clicking the link on this page. Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the second in our 5-part video series called Where to Buy Investment Property. So far, we've looked at the impact of infrastructure spending, and in this video, we're going to look at the next two critical factors you should look for in ascertaining where to buy investment property, and they are population growth and job creation. Population growth is the catalyst for all increases in property values and rents. Without a growing population, you won't have growing prices. In fact, without a growing population, prices will stay still at best, or even decline. Consider, for instance, a country town whose sun may have set in previous decades. It used to house, say, 10,000 people, and now, because there are no jobs and few prospects, it's declined to maybe 6,000. Those remaining 6,000 will tend to be older people, and they won't be generating much in the way of new wealth. Few of them will rent, and there will be empty houses everywhere, in fact, enough to house 4,000 people. So obviously what we want is the opposite of this. Australia's population grows every year. The amount fluctuates, but in rough terms it's around 200,000 to 400,000 new people, which is about 1.5% a year. In addition, people move around within the country chasing jobs. So the trick is to invest in an area ahead of or during a sustained period of population growth. A good starting point is a population growth rate above the national average. So 2% is good, 3% is even better. But the demographics of that population are equally important. For example, an area that's surging with retirees will create price growth, but the rents won't be so strong because retirees don't have big bucks to spend on rent. Many of them own, which is what will create the rising values, but few of them rent. And if they do rent, they're often on fixed incomes and can't afford the sort of rents we're after as investors. So what you want to look for is areas where the population is growing, and that population is a young, working age population who are being attracted by the high-paying jobs. These people bring their partners and their families. They need housing, they're earning good money, and they'll spend a decent proportion of it on rent. They also often want to rent new homes, which investors can often provide because of the depreciation benefits. These working age people push up the rents, which means that investors don't have to contribute much out of their own pockets to provide the investment property. As rental yields rise, more investors are attracted to buy, which in turn raises values. And of course, some of the new workers will settle and buy, and this too puts pressure underneath property prices. So population growth and job creation, the right kind of job creation in particular, are two of the most important factors to look for when ascertaining where to buy investment property. And in video 3 in this series, we're going to be looking at the safety of property investment. And you can see this video at propertyinvestmentprofessionals.com.au or by clicking on the link on this page. Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the first in our 5-part video series called Where to Buy Investment Property. There are 3 major criteria that you should always bear in mind when looking for investment property. Firstly, you want to achieve the highest possible capital growth. Secondly, you want to achieve the highest cash flow so that owning an investment property won't cost you an arm and a leg. A rough benchmark that most of our clients want to achieve is a property that will cost them no more than around $100 a week out of their own pocket. And the third but equally important criteria is to invest safely, minimizing the risks as much as possible. So to balance these 3 factors, the first thing that we look for is infrastructure spending. Infrastructure spending is one of the most powerful influences of property price growth. So you should be looking to buy an investment property that's close to where new infrastructure is going. All sorts of infrastructure is good, such as new roads, bridges, train lines, but the best possible infrastructure for you to invest near is large-scale infrastructure that's going to attract people and generate wealth. New public facilities like schools, hospitals, shopping facilities. But even better is really large-scale private investment that can completely transform an area. These can be related to the resources industry, such as new ports, freight facilities, railways, mines, processing plants, and so on. And the reason these infrastructure projects make such a big impact on property values and rents is because they create surges in population and jobs. Large numbers of jobs, preferably highly paid ones, so that all those new workers need to seek accommodation. And they all need to either rent or buy. And when they come through in such numbers, they push rental yields up and create price growth as they buy. Both of which, of course, are excellent for investors who've got in ahead of this trend. And it's these 2 factors, population growth and job creation, that are the subject of our second video in this series on where to buy investment property. And you can watch that video at propertyinvestmentprofessionals.com.au or by clicking on the link on this page.